Hi everybody, hope you're well. Today's video is going to be on the finance front. We're going to be looking at margin of safety, the concept of margin of safety in theory, and I'll show you some live examples, illustrative examples of what I would look at in order to employ this concept of margin of safety whenever it comes to making investments. Um, Basically, the intelligent investor is the go-to guide for starting off any financial advisor or investor or trader that's looking to start up trading will go to this book as a kind of they should go to this book as kind of their starting point for getting a grasp of the key core fundamental concepts that you need to learn and implement in order to successfully make investments consistently without losing money effectively. And the guy who wrote this book in the 30s, I think, Benjamin Graham, was the mentor of Warren Buffett, who more of you would probably have heard of, as he's probably the most successful investor of the last 100 years. And his business partner, Charlie Munger, they're both in their 90s now. He also took instruction from the teachings of Benjamin Graham. And, you know, people are increasingly aware of the fact that as a result of inflation and things like this, it can be dangerous. It can be almost as risky in ways to sit on cash if you have any, as it is to get involved with different investments, because you know by sitting in cash that the value of that money is going to dilute in time as a result of inflation. My main concern there is that I think that as a result of that, too many ordinary people are getting exposed to too many markets at the moment, and we're somewhere very, very close to a market top in most markets. However, there are always opportunities to get involved in different assets, whether it might be just looking at different countries, different industries, different types of assets. Looking at something like bonds or shares or cryptocurrency, or there's always different things that you can look at, retail or real estate, land. Just there are so many different things which perform well even whenever all others are performing poorly. So providing you apply principles like margin of safety effectively and consistently, you should be pretty much putting yourself in a position where you're minimizing your downside risk consistently while making sure that you've opened that window to maximize upside reward. So yeah, I one of my friends, a chartered accountant who has saved up some money over the last few years working. I basically was discussing these concepts with him at the weekend. I don't know what the situation is in the United States, but here in the UK framework, you can take advantage of an ISA up to the value of £20,000. Every year, you can put money into your ISA, and if you make any if you make any profit on investments that you make within that ISA, it's not subject to capital gains tax, so you don't have to pay any tax on it. So, you know, I started discussing this with him, got him involved coincidentally on Tuesday with a particular investment, and just pure random chance, it's gone up by like 40% in the last 2 days. So it's it's been a great start for him. But it's just got me thinking more generally that there are a lot of good quality concepts out there that ordinary people aren't taught about and don't know about. And if you kind of consistently apply them, you're going to put yourself in a position where you're again minimizing downside risk and maximizing upside risk. But the problem is most people typically chase the rainbow in different ways. So as I'll show later, most people are, a lot of people are rushing towards buying things like Bitcoin at the moment, even though it's gone up 20 times in the last 12 months. Now, long term, it could and likely will go much higher than it is now, but probably short to medium term, there's more downside risk and certainly no margin of safety um, if you're to be getting involved now. So we'll look at that. But what I'm just going to do quickly is read out. So chapter 20 of The Intelligent Investor is let's see what it's called, margin of safety as the central concept of investment. And I'm just going to read out the to sum up bit at the end, and then I'm going to show you some live examples of what I would look for in terms of margin of safety. More looking at charts than anything else, but I can also explain how it just interrelates with the fundamentals of the business itself. That's what you're looking for. So to sum up, it just talks about a few different principles here. The first and most obvious principle is know what you're doing, know your business. So don't just get involved in things that you only half know or don't really know about. For the investor, this means do not try and make business profits out of securities, that is, returns in excess of normal interest and dividend income, unless you know as much about the security's values as you would need to know about the value of merchandise that you propose to manufacture or deal in. A second business principle, do not let anyone else run your business unless you can supervise their performance with adequate care and comprehension, or you have unusually strong reasons for placing implicit confidence in their integrity and ability. A third business principle, and I think this is the main one which kind of ties in with this idea of margin of safety, do not enter upon an operation, that is manufacturing or trading in an item, unless a reliable calculation shows that it has a fair chance to yield a reasonable profit. In particular, keep away from those ventures in which you have little to gain and much to lose. So no matter what it is that you're getting involved in, like say people right now are maybe sitting in money and they're thinking about getting involved in property, you got to realize that property prices in terms of historic norms are like incredibly high. And the crash that we experienced in 2007, 8, 9, for the most part was a crash of in and around 40 to 50%. Whereas most assets, whenever they go through cyclical kind of major crashes, as we saw on cryptocurrency between the peak in 2017 and March 2020, things fell by 80 to 90%. So that potentially could happen in housing markets in the next few years. So yeah, again, always try and figure out a scenario where you're getting involved, where there is, in your view, in your judgment, there is little risk. There'll always be some amount of risk, but you can find scenarios where there's minimized downside risk while ensuring that there is significant upside potential return. A fourth business rule is more positive. Have the courage of your knowledge and experience. If you formed a conclusion from the facts and you know your judgment is sound, act on it, even though others may hesitate or differ. You're neither right nor wrong because the crowd disagrees with you. You're right because your data and reasoning are right. Similarly, in the world of securities, courage becomes the supreme virtue after adequate knowledge and a tested judgment are at hand. Fortunately for the typical investor, last bit, fortunately for the typical investor, it's by no means necessary for his success that he brings these qualities to bear upon his program, provided he limits his ambition to his capacity and confines his activities within the safe and narrow path of standard defensive investment. To achieve satisfactory investments is much easier than people realize. To achieve satisfactory investment returns is much easier than people realize. To achieve superior returns is a lot harder than it looks. So that's it. Through applying this idea of margin of safety, where you're minimizing downside risk and you're maximizing upside reward, if you do that consistently, it'll be easy to achieve satisfactory results. It becomes harder to make superior results. But if you consistently go for satisfactory, you can potentially just double, and in time you can really roll that snowball and build quite a large portfolio. Anyway, we'll dive into the screen share here, and I'll just show you a bit more about what it is that I'm looking for specifically when I'm trying to assess an asset which has a strong margin of safety. Alrighty, so I'll start by reading out, I didn't do it before, the definition. What is margin of safety? Margin of safety is a principle of investing in which an investor can only purchase securities when their market price is significantly below their intrinsic value. In other words, when the market price of a security is significantly below your estimation of its intrinsic value, the difference is the margin of safety. Because investors may set a margin of safety in accordance with their own risk preferences, buying securities when this difference is present allows an investment to be made with minimal downside risk. Now, what I want to do is show two different assets, one being Bitcoin and one being just some relatively small UK-based share that I'm holding at the moment, just because I mentioned it in a video a few weeks ago. It gives you a good illustration of the idea of how you can apply the concept of margin of safety in your investing here. And I just want to show you how like Bitcoin now is an example of an asset that a lot of people are getting involved in now. And if you got involved in it, you know, a year ago or 6 months ago or 3 months ago, kudos to you. But I just want to show you how there's no margin of safety now if you were to consider investing in it yourself now for the first time. So what you can see here on the screen, this is a trading view. It's a tool that traders can use to assess the technical analysis of different assets. And here what we can see is the peak of the last bull run with Bitcoin and cryptocurrency in general. So this is December 2017 when things peaked at 20,000. Now, if you were to be buying anytime just shortly before then or at that peak, when the hype was at its greatest and when people were talking about it the most and whenever it was on the news and media and things like that the most. By the way, that in itself is a bad time to invest in anything. You want to invest in things whenever they're kind of unloved and no one's talking about them. And then whenever there is that euphoria and hype and buzz and things are in the media and papers, that's when you want to be selling. That's the time to offload, if that makes sense. Although the natural human bias and tendencies and temptations are to do the very opposite. But if you were to have invested in 2017 in December near the peak, you're in a scenario where you're buying in when things are basically shooting up in the sky, and as a result there's no margin of safety. The idea is that if you're to invest in a business and it has a strong margin of safety, the share price may have suffered a lot in the previous weeks, months, and even years as a result of the share price dropping, or the crypto price or any asset price dropping. That in itself creates a margin of safety, because if something drops by 50, 67% in value from its peak, the likelihood of it continuing to drop substantially is much lessened, especially if it is at a business or a company which has reasonable expectation for you to believe that there will be future demand for their products and services, future maintenance, if not growth in revenue, in gross profit, in net profit, in profitability, and net assets in general. So here we can see, and I can show you where the margin of safety starts to creep in for Bitcoin over the months that followed, months and a couple of years that followed the peak in 2017. So things from the peak in 2017 started to aggressively fall. Literally each one of these green and red candles represents 1 week. So literally a week after it hit 20,000, it went as low as like 11,000 approximately. And it sort of like had some pretty significant volatility over the next few weeks, you know, pretty much moving sideways for the most part, and then it aggressively fell again. Then things moved sideways roughly again. We're now well beneath 10,000. You know, it was at 20,000 at its peak, and it got as low as it fell as low to about 3,200. So that was something in around the region of an 85% reduction in the value of Bitcoin from its peak at 20,000. So if you can imagine if you can just follow what I'm saying here, if you were to be buying at the peak, there's no margin of safety. And you didn't know that it was to be the peak, but you just knew that you were buying an asset which has been going up substantially percentage-wise for quite a prolonged period of time. But the margin of safety in any asset is created when things start to fall aggressively and fall for quite a prolonged period of time as well. It's time and percentage drop you want to be looking at. So you could feel quite good about any investment that you see falling in this instance by, say, approximately about 60 or 70% here. If you started accumulating it here, brilliant. And then if things fell aggressively, now the problem is when things start to fall even further, typically people panic and sell. But what you really ought to be doing then is being like, brilliant, so I've started investing in this asset at a discount, and now it has fallen further, and all that has done is increase the discount value. So I'll continue to accumulate more and accumulate more and accumulate more. Now, things got as low as 3,200 approximately, and obviously since we've had an absolutely insane run throughout this last year in particular. Sorry, I mentioned that from March 2020 to now, Bitcoin increased by 20 times. It was actually just over 10 times, but not far off 20 times from its low at 3,200 though. But yeah, so here it's a bit mad. I need to adjust the chart here, but like if you consider this is the peak here of 2017, and here's where we're up to now. Now, am I saying that this can't go much higher? No, I am not saying that, far from it. However, is there a margin of safety here? What do you think? What do you think? This asset was worth 5,000 a year ago, and it's now worth almost 60,000. And even like, just look at the chart. Look at the chart. There's no. So my point is, and Benjamin Graham's point in The Intelligent Investor was that if you want to be buying an asset that has a substantial margin of safety, you ought to not be buying an asset like this right now. Long term, can it do well? Absolutely. Short term, medium term. Are you putting yourself in a position where you're intelligently investing? No, because there is no margin of safety there. So if this were to fall again by something like 60, 70, 80+%, would it be a good time to invest? Absolutely. Absolutely it would. But wouldn't recommend it. Not financial advice, educational purposes only, but in terms of applying those good old principles from Benjamin Graham and margin of safety, there is none now. Now, by contrast, although it's had a bad day or two, this small company, it's called Beeks Financial Cloud. I only mention it because I mentioned it in one of the previous videos that I did on this, and this is where right now this is where I made the video around the mid to end of January. And basically what I want you to understand here is this company went live in the stock exchange at the end of 2017. Within 9 months, it had gone from, its starting point was about 42 pence a share. It had got as high as 145 pence a share. Now this is September 2018. Now, I'll not get in deep into it, but in a nutshell, the fundamentals of this company have continued improving in all reasonable ways throughout the lifetime of this company. So the share price in itself is not reflective of the company's performance, if that makes sense. You know, it's gradually improved. So really it should be kind of going up in a straight diagonal line if the share prices weren't kind of manipulated, and if they were a better reflection of how the company's actually performing. So this company, it was 145 was the value of its share price. You can see it over here. 146 maybe at its peak in September 2018. If you go a year later, so September 2019, we are here. So we're in and around 90 a year later, which is approximately a 40% reduction from its peak a year prior. Now this was probably a euphoria moment. It was probably overvalued in terms of the share price at the time. But just to give you an idea, yeah, a year after its peak, it had fallen by about 40%. And then another year later, if we go to September 2020, we're still knocking around 90. So what we had here was a scenario where there was a share which has fallen for effectively 2 whole years. Like, it only had a 9-month bull run, and then 2 years of basically fallen and sideways movement. And what I can tell you is that this particular share, its revenues are about twice as high now as they were here. Its gross profit, net profit, the amount of
large customers, clientele, retained monthly revenue contracts, things like this are all approximately double now what they were then, and there's substantial reason to believe, in my view, that the company fundamentally will perform well going forwards. So whenever I made the video a few weeks ago, the price was around 89.90 here, and that's when I was explaining then that there was. Now, I was just touching on that point. I wasn't going specifically on margin of safety like I am here, but that there was substantial margin of safety in this company as a result of the fact that it looked undervalued compared to like its previous performance in terms of the share price performance. So I basically put a substantial amount of my own portfolio in this company. And here's what it's done the last few weeks. So it crept up a bit, crept up a bit, crept up a bit. It's given people every opportunity to sell without actually making a pretty seismic move in one given week, if that makes sense. It got as high from the lows there of like 85, 86 to 125, and the last 3 weeks it's kind of gone sideways. It's had a pretty bad couple of days, but I've every faith that things are going to continue going strongly upwards. But basically that in itself should show you an idea of this idea, a live example of margin of safety, and how if you consistently utilize this method of investing as a kind of core principle of your investment strategy, it shouldn't really matter that much, you know, what else is going on in the rest of the world. Because my concern is that most assets, let me see here, most markets and things like this are substantially overvalued. There's all sorts of different reasons why. Where are we? There's all sorts of different reasons why there's an expectation that there's going to be a seismic move down across most markets at some stage imminently soon, I would say. Actually, I'll get up the Dow Jones just to show you. But the thing is, that tiny small UK stock is an example of something which, you know, it's doing its own thing. It's not necessarily as part of the system as all these other ones. Like, this is the Dow Jones, the performance of the Dow Jones for the last 100 years here. Again, this is the dot-com bubble. Boom. This is the Great Recession, 2007, 8, 9. And here's where we are now. So talk about a lack of margin of safety in investing in these major markets. There's no reason why this couldn't completely capitulate sometime very soon. But there are opportunities out there as long as you find that margin of safety. And if you do that consistently over time, over a lifetime, you know, and you're quite stoic in your approach and you don't overspend and things like this, and you can continually add whatever little you can to investments, you'll do really, really well. So yeah, be interested to hear your feedback on this. Went on way longer than I was expecting to, but anyway, hopefully some good stuff here. I'm going to start doing more things like this. I think just taking one kind of concept or idea and rolling with it. Anyway, yeah, much love, God bless, keep the faith.